Hello and welcome to our personal finance channel. Today, we're going to be discussing a topic that's been debated for years in the investing world: passive vs. active investing. As a viewer, it's essential to understand the difference between the two and how they can affect your investment portfolio. My name is The Financial Edge, and I'll be your guide through this video. So, let's get started. Welcome back. In this video, we'll be discussing one of the most debated topics in the investing world: passive vs. active investing. Let's start by defining passive investing. Passive investing is a strategy where investors buy and hold a diversified portfolio of securities, such as index funds or exchange-traded funds, in order to match the performance of a market benchmark. Passive investing differs from active investing, where investors try to beat the market by actively buying and selling individual stocks or other securities. Active investors spend a lot of time researching and analyzing different investments, and they often pay higher fees for the services of professional fund managers. On the other hand, passive investors believe that it's difficult, if not impossible, to consistently outperform the market over the long term. Instead, they choose to invest in low-cost index funds or ETF that track a specific market index, such as the S&P 500. Some popular passive investments include Vanguard's Total Stock Market Index Fund, the iShares Core S&P 500 ETF, and the Schwab U.S. Large Cap ETF. Active investing is the opposite of passive investing. It involves researching and analyzing individual stocks, bonds, or other securities to try to outperform the market. Unlike passive investing, active investing requires a more hands-on approach. Investors who pursue active investing typically aim to beat market benchmarks and generate higher returns by buying and selling investments based on their own research and analysis. However, active investing involves higher risks, as it relies heavily on the individual's ability to predict and react to market fluctuations. Examples of active investing include buying individual stocks, actively managed mutual funds, and hedge funds. These types of investments require investors to do their own research and make decisions on what to buy or sell, which makes it a more time-consuming and potentially risky endeavor. Now that we've covered what active investing is, let's discuss some of the benefits and drawbacks of this approach. One benefit of active investing is the potential to generate higher returns. Skilled investors who conduct thorough research and analysis may be able to identify undervalued stocks or other securities that have the potential to outperform the market. Another potential benefit of active investing is the level of control it offers. Unlike passive investing, active investing allows investors to make decisions based on their own analysis and judgment. This level of control can be appealing for investors who want to have more input into their investment decisions. However, active investing also comes with some drawbacks. One of the main drawbacks is the higher fees and expenses associated with actively managed investments. These fees can significantly eat into returns, especially if the investor is not able to outperform the market. Another potential drawback of active investing is the higher level of risk. Because active investing relies heavily on the investor's ability to predict and react to market fluctuations, there's a greater potential for losses if the investor makes poor decisions or fails to accurately assess market trends. Overall, active investing can be a viable strategy for investors who are willing to put in the time and effort to conduct thorough research and analysis. However, it's important to consider the potential drawbacks and weigh them against the potential benefits before deciding which approach to take. Now that we've covered the basics of passive and active investing, let's dive deeper into the pros and cons of passive investing. Passive investing offers several benefits that make it an attractive option for many investors. One key advantage is lower fees. Passive investments such as index funds and ETF typically have lower fees compared to actively managed funds, which can eat into your returns over time. Another advantage of passive investing is diversification. With passive investments, you can gain exposure to a broad range of assets or sectors, which can help to reduce your overall investment risk. However, there are also potential drawbacks to passive investing. One major concern is lower potential returns. Because passive investments track an index or benchmark, they are designed to match the performance of that benchmark, rather than beat it. This means that if the market is performing poorly, your passive investments will also be affected. Another potential drawback is a lack of control. With passive investing, you are essentially delegating the investment decision-making to an index or benchmark, which means you may not have as much say in the individual companies or assets that you are investing in. So, while passive investing can be a great option for many investors, it's important to consider both the pros and cons before making the decision. Active investing can potentially yield higher returns than passive investing, which is one of its biggest benefits. Investors who are successful in active investing can outperform the market, generating returns that can surpass those of passive investments. Another benefit of active investing is the level of control it provides. Active investors can pick and choose which stocks or other securities they want to invest in, and they have the ability to quickly sell or adjust their positions based on market movements or changes in their outlook. However, there are also potential drawbacks to active investing. One of the biggest is the higher fees associated with actively managed funds or trading costs for individual stocks. These fees can eat into an investor's returns and make it more difficult to outperform the market. Additionally, active investing can be more risky than passive investing. An individual's ability to predict and react to market fluctuations is not foolproof, and there is always the risk of underperforming the market or losing money. Furthermore, active investing can be time-consuming and require a great deal of research and analysis. Investors need to stay up to date with market trends and news, as well as continually monitor their investments to make informed decisions. It's also important to note that active investing is not suitable for everyone. It requires a level of expertise and knowledge that not everyone may possess. For many investors, passive investing may be a better option. Now that we've discussed the pros and cons of both passive and active investing, it's important for investors to carefully consider their own goals, risk tolerance, and investment expertise when deciding which approach to pursue. And that's it for today's video on passive vs. active investing. To quickly summarize, passive investing involves investing in funds that track the performance of a market index, while active investing involves buying and selling individual stocks and securities in an attempt to outperform the market. Passive investing is generally considered a lower risk and lower cost approach, while active investing can potentially offer higher returns but also involves higher fees and greater risk. Ultimately, the choice between passive and active investing depends on your personal goals, risk tolerance, and investment strategy. It's important to do your own research and make informed decisions based on your individual circumstances. I personally believe that a combination of both passive and active investing can be a good strategy for many investors. Thank you for watching this video, and don't forget to like and subscribe to the channel for more personal finance tips and content.